liquidity. Okay, and liquidity is one of the most understood concepts in trading because many people never fully understand what liquidity is, and that's what allows the market to function efficiently. So we have different types of liquidity, and I'll be taking you through them and also how to understand liquidity. First, what is liquidity? Liquidity is literally the availability of buys or sells order in the market. That's it's literally money. I would always say liquidity is literally money in the market. But now you have to understand or realize where this money is sitting, and they're usually in places where others are taking buy or sells order because there's always a large amount of stop loss at certain levels because multiple traders are taking from that same level. That's the point of liquidity. Do you understand? So we have the buy side liquidity, and this is usually sitting at tops like this: previous swing low, previous swing high, buy side liquidity at the previous swing high, or usually around equal highs. For instance, points like this, there's a buy that's a buy side liquidity, right? And then there's a swing high, that's the buy side liquidity. Do you know why? Because lots of traders will take trades from this level. Let's say, for instance, you trade support and resistance, right? You have a support here, price comes back into it, automatically there are trades sitting here, which means there's a lot of liquidity sitting around this point. There's buy side liquidity, lots of liquidity sitting at that point. Because let's say we have a million traders that trade support and resistance. This is a 4-hour time frame. They are looking to take an entry from this level once price retests back into the support, right? So which means automatically they have entries at that level and stop losses slightly above that level. So that place has high liquidity. High liquidity. But it's a buy side liquidity because it was taken from this level, irrespective of the fact that this was the setup that brought it back. It was taken from this level and stop loss is slightly around this level too, right? And then we have the sell side liquidity. Let me do well to mark that out. And then we have the sell side liquidity. This is the buy side liquidity. This is the buy side liquidity. Sorry, I didn't intend to hide that. Okay. The buy side liquidity is always at the swing high, and then we have the sell side liquidity at the swing low, which would be areas like this. Do you understand? And we'll also have buy side liquidity here, sell side liquidity here. So the buy side liquidity is the swing high, the sell side liquidity is the swing low, and then we also have equal tops or equal lows. This can also identify strong buy side or sell side liquidity too. Now, because you know why equal highs and equal lows will actually be considered as that is because price retested that area, giving traders the opportunity to re-enter. People that have missed out on that trade would enter again. So it's usually stronger. Liquidity is even sitting there strongly than even one time retest or just one single high or low. A double high or double low is stronger than just one. Do you understand? Because aside the traders that first had the opportunity to take this trade, market has given them the opportunity to take the trade again, targeting the same level again. You can imagine the number of people that would sit on that trade again. And even people that are already on the trade would try to even get in again once they have certainty or confirmation that it's actually forming a double or an equal top. They would actually enter. So you can imagine the large amount of trades that would be sitting at that level, which is why it's always a spot for liquidity because lots of money are at that place. That's why I would tell people liquidity is literally money. Look at your chart, talk to yourself. Where do I think lots of trades will be sitting depending on what just happened in the market now? This is it. And it's always going to be a magnet for price to pull back to. It's always going to be a magnet for price to pull back to. That is why most of you, when you trade fair value gap, you see price pulling back to your fair value gap. There's a lot of trade that had gone down, and that area, that's why price is attracted to it. There's lots of money there. People that trade fair value gap probably have their entry at the retest of that, or immediately that candle breaks out the previous one, and then they the only reason price is going to push like that and leave imbalances is due to high orders in the market. Due to high orders in the market, that's the only reason price would leave an imbalance like that in the market. Now, price will always attract it back to that level, but during while it's attractive back to that level, it takes out people too, and it gives some people the opportunity to get new entries, right? Those are what happened in the market. Those fair value gaps that you see is as a result of orders, very large number of orders from that direction. And why that is why price has to go back there, clear out the imbalances, give you an opportunity to enter again, and also stop out certain people. Just so you know, a lot of people are getting stopped out at those retracements back to your fair value gap. So you need to be able to look at your chart and say, oh, this point, price pushed aggressively or impulsively from that point, there has to be liquidity there because that's what makes the market efficiently move. There has to be money in the market for it to efficiently move, because what we do is trade. We trade, right? And trading is just between the buyers and the sellers. There has to be money for there to be trade. And if you see impulsive moves in the market, there's a huge sum of money placed in the market. And the price would always, or there's a huge amount of order placed in the market. And price will literally hunt for those orders. Just so you know, it will literally hunt for those orders. That is why people would make phrases like, you don't own the market, go in, go out. Do you understand? Because you can't be too comfortable there. The market is always plotting to take your money, and that's it. Now, we also have what we call the resting liquidity. This is usually when you have orders sitting at certain levels. Let's say, for instance, like this point where we're waiting a retest, and then you're like, oh, so I don't miss out on this trade, I might as well place a sell limit on that level. This is what we call resting liquidity. They can literally see that orders are piled at certain levels and their buy limits or their sell limits or their buy stop or their sell stop. So for those of you that don't understand buy stop and sell stop, because I was once there and it was kind of complicated, but now it's very easy. So for the buy stops, it's usually above the current price. And if it's going to be it's bearish, it's below the current price. So if price is, let's use this as an instance, if I was to place a buy stop, I would have a buy stop here. If I'm expecting that price would break out that high, I would have a buy stop there. If I'm expecting price would break this low, I have a sell stop there. And if I'm expecting that price returns to this level, like a retest on whatever direction, like a retest, I'm expecting price to return to this point and then continue downwards, right? It's not a breakout, it's more like a retest, but I'm expecting it to sell. I would place a sell limit at this point, waiting for price to buy back to that point and then sell. And then if it was for us to buy, then I would actually place it here, right? Waiting for price to return. Let me look for an appropriate one. Give me a minute. Let's say I would place it, yeah, and let's say waiting for price to return, so I would place my buy. Let's use somewhere here. Let's say I'm waiting for price to return to this level and then continue to buy. I would use my buy limit at this point. So that's literally how to do it. I know we're talking about liquidity, but most people don't know how to use the buy stops and all of those things. That's why I'm explaining that right now. Now back to what I was saying. back to this point, those are what we call resting liquidity. That's the reason I had to explain. Because when you place those orders, the market can see them, and those are called resting liquidity because there's money at that point. You can't just place orders without having a stop loss, right? So there's lots of money sitting at those certain points, and we're expecting price returns there, depending on whatever strategy. But trust me, in a world full of 8 billion people, a million person is betting on one particular strategy, and they're all sitting at a particular point. Another million is sitting at another particular point betting on that same strategy they all trade. Even if they're across the entire continent or the entire world, it's that's exactly what happens. And then we have the active liquidity. This is when you take trades like immediately, instant execution. When you see market execution there, it's instant execution. Those trades immediately. You're not waiting for price to return somewhere. You're not saying, oh, liquidity is gathered here. Just instant execution because you probably must have seen confirmation on certain trades you're waiting for, or you're someone that has fear of missing out. So you follow an impulsive trend, and you all of that. The instant execution is the active liquidity. It's what's running right now. Those trades are already open. It's what's running right now. It's the active liquidity. So you can see that there's not so much to liquidity, and it's so easy. But most people, that's the toughest thing they're going to spend years never understanding. And the reason why we need liquidity is because it's mostly liquidity is understanding where liquidity is likely to help traders to understand why price often moves towards certain areas. Do you understand? Liquidity would always attract price back to you because when price comes back to your liquidity and it gets to your stop loss, it will take you out. Literally, the market has liquidated you. It has taken you out, and it has your money now. So those areas will always attract price. Those areas will always attract price. So you have to understand this, and you have to. So one of the mistakes that people make is thinking that liquidity also guarantees a reversal. So sometimes it does not always guarantee reversal. Do you understand? It does not always guarantee so understanding liquidity begins with understanding where others are likely to be located because money is likely to be placed in those same areas while others are there. There's no order without money. You cannot trade without money. So anywhere there are others, there's money. Anywhere there's money, the market wants it and it's going to come for it. If you're among those that are going to be the early enterers, I'm not saying you should be too cautious, but I'm also saying you should also be careful. So yeah, that's all you need to know about liquidity. And for your for trading view for XNext, like I always say, I'll leave the link in my description. Do have a nice day, guys, and you can always come back to the video and watch over and over again till you understand and comprehend what liquidity is and how to spot liquidity.